Amazon's first U.S. bond offering in 3 years, set to raise $15 billion. Another testament to the need for funding flexibility in the era of AI spending. Here to break this all down is Robert Schiffman, who covers tech and credit over at Bloomberg Intelligence. Robert, great to have you with us. This seems like a real sign of the times, the fact that Amazon is tapping the public bond markets for the first time since 2022. What does this say? Why tap the bond markets versus look to free cash flow, for example?
Well, I think you better get used to it and get used to having me on, because this is not going to be the first conversation. There is a lot of money to raise over the next few years because there's a lot of money to spend to build infrastructure, because there's just a tremendous amount of demand. The type of demand I don't know if we've seen for any product, maybe since the automobile started to come around to chase the horse and buggy. So what does it mean? It means that Amazon, along with Meta and Microsoft and Alphabet and Oracle and probably a host of others, think that there is money to make out there. And the reality is they can't make that money over time unless they put the money into infrastructure right now. Many of the companies are very differently positioned. Amazon is much differently positioned than some of their peers, which gives them, I think, an enormous leg up. We can talk about that in a second, but this is just the start of things to come.
Just the start of things to come. And it's an interesting chicken and egg situation because, I mean, you think about Amazon and some of their peers, they have best-in-class credit ratings, but part of the reason they have those ratings is because scarcity creates value. They don't issue that much debt, and I'm not suggesting that they're going to get downgraded anytime soon, Robert, but I wonder what you make of that dynamic.
It's actually a bit of a misnomer. They do have a lot of debt. You know, Amazon's got $50 billion of debt out there, and if you include all their leases, it's $350 billion of debt. If you look at names like Apple, they're sitting on $100 billion of debt. Oracle is over $100 billion of debt. These companies have raised money over the last handful of years. The real question is, why haven't they raised more? And simply, the vast majority of the funds that they were making were used for shareholder returns. And now that they have something real to spend it on, quite frankly, the government limited a lot of what they can do from an M&A perspective. And we always thought they should raise more. If you think about their weighted average cost of capital, you know, their weighted average cost of debt is effectively zero, and their cost of equity is 10%. So why weren't they issuing even more? Why didn't they have $200 billion of debt and buy back more stock? And I think these guys have foresight. It's as simple as that. The CEOs, whether it's at Meta or Microsoft or Alphabet, these guys saw this sort of spending spree coming, and they wanted to make sure that their pockets were deep enough that when they needed to spend the money, it was going to be there. But quite frankly, the amount of money they're going to need to spend over the next few years is even bigger than that. We wrote a note the other day saying that the big 5 or 6 were going to spend about $3 trillion over the next 5 years on AI CapEx. And when you start throwing in the others like CoreWeave and Anthropics and all the others, you know, maybe that number's more like 4 or 5 trillion.
But to your point, though, Robert, just about the idea that some of these companies were already sitting on a lot of debt, I do want to go back to Oracle's sale a month or two ago, $18 billion bond sale. I mean, they were already sitting on like $100 billion in debt as it was. They kind of dominate several of the key investment grade indexes. And I'm wondering if, as we see more of these larger companies take on more debt for something that, at least right now, is still a questionable ROI, is there any concern about any sort of risk, systemic risk, to some of those broader bond indices if anything does intentionally go wrong?
No, well, the general answer is no. It's certainly company specific. You know, other than Oracle, the other names that we're talking about are all AA or maybe AAA companies. They're actually generating massive amounts of cash. They've got little to no leverage. In fact, many of them have negative net leverage. So the amount of financial flexibility that exists in those systems is extraordinarily high. If they ended up making mistakes and there's sunk costs, and they have to pull back in the next few years on their CapEx, I don't think that's going to matter whatsoever in terms of their credit rating. We haven't seen one of these big companies have a credit rating turn negative. Oracle's a little bit different. Oracle, over the last handful of years, has been spending money on acquisitions and shareholder returns, levered their balance sheet to BBB, and is really pushing the limit. The way to get around that for a name like Oracle, though, is you start doing off-balance sheet financing. They're not the other ones. Intel was the first really to start this with Foundry JV. And then we saw Meta, and we're likely to see Oracle. So there's still a lot of flexibility in the system. This whole concept that we are about to enter some sort of bubble that's about to burst, I don't think people could be more wrong. There's a bubble. But it's a bubble of demand, and it's going dramatically bigger.
Yeah.
I don't see risk throughout the system at all. Now, listen, could there be idiosyncratic risk? Yes. As you move down the curve, as you move into high yield land, and you start thinking about names like CoreWeave, the risks get higher. But the reality is there's revenue on the back end of that. And for all those naysayers that don't believe that those revenues are there, I think they're going to be proved sharply wrong.
All right, Robert, we got to leave it there. Robert Schiffman over at Bloomberg Intelligence. A closer look here at Amazon and some of the other big hyperscalers going to the debt market to fund their AI dreams.